Zoetis is down 18% just year to date, trading towards its 52-week low with some massive upside from Wall Street analysts. Now, this is one we reviewed in our weekly episodes recently, and today we are going to do a deep dive, given this really needs to be on your radar. We're going to take a look in today's episode. Already we can see both Wall Street analysts and Seeking Alpha analysts declare this as a buy. Now, what we're going to do in today's episode, we are going to run through this company in detail. We're going to look at their top line revenue growth year on year, as well as their bottom line net income. We're going to review the health of this company, their total cash versus their total debt. And we want to see how well or how poorly they're performing versus the industry over the last 10 years. We're also going to talk about not just their dividend safety, but also run through a lot of their metrics, free cash flow, the net debt to EBITDA. And we're also going to take a look at both insider ownership as well as the institutions to understand what they are doing with this company. And as always, we do want to pull out a few slides from their latest investor presentation that we do believe to be useful for yourself. Don't forget, we're also going to run it through the valuation model, getting to our intrinsic value as well as our acceptable buy price given our investor margin of safety, and look at Wall Street and see what they forecast with this company that has some very, very, very strong upside for your portfolio. So jumping into the historical performance of this company, they're down 18% just year to date. Over the last 12 months, still down around 4.5%. If you've been holding over the last 5 years, you would be up 60%. Bear in mind, it doesn't include those dividends reinvested. And if you're a shareholder over the last 10 years, you would be loving it right now, up 466%. Again, this would be higher if you were reinvesting those dividends, but what we can see is it has fallen from the back end of 2021 at its all-time high at around the $243 mark. Now, as we mentioned, it is trading at its, or in fact near its 52-week low. It does offer a yield of just over 1% and currently trades at a forward P of 28.2. Now, for companies, when we review them, the top line, we want to see a minimum of 3 to 7% growth year on year. What we can see for Zoetis, 4.8 billion reported in 2014. Latest annual accounts, 8.5 billion. So they are growing at a decent rate. We can also see in the graph format, it is moving in the right direction, nearly doubling their top line from 2014 as well. So looking good on the top line. However, what story can we see on the bottom line, net income? Well, actually, they're growing their bottom line at a faster rate than their top line. Under 600 million reported in December 2014 for net income. December 2023, 2.3 billion. So they are growing at a very rapid rate. Top line nearly doubled over the last 10 years. Bottom line, in fact, we can see nearly 4 times over the same period. And when we look at it on a graph format, we can see it is moving as expected in the right direction. So income statement does look very healthy for this company. Quick look at the health of this company, their total cash and short-term investments versus total debt. 882 million, as we can see, held on that balance sheet. Latest annual report, 2 billion or just over. So we can see their cash balance has increased over the last 10 years. Now, when we compare that to their total debt numerically as well as directionally, we can see it has gone from around 3.6 billion to around 6.8. So whilst their cash has increased, so has their total debt. No real red flag indicators at the moment, but something we can look at when we do discuss their dividend safety and some of their debt metrics. Now, when we look at the pharmaceuticals industry, we do have a few competitors. Again, these are very well known, most of them that we have reviewed on the channel as well. What we can see, total return, including dividends reinvested, they would be down around 4.5%. Interesting, though, to note that over the last year, they are one of the best performing. Only one of them, in fact, GSK, giving positive returns over the same period. When we extend that to the last 5 years, however, what we note is they are the second best performing, again, up 66%, half of the market up with the other half down. And when we zoom out to the last 10 years, they are the best performing, up 508%, and that is including those dividends reinvested. Very, very strong performance. Make sure as well in your own investment thesis, you do understand that past performance is not an indicator of future performance. Now, in terms of looking at some of their underlying metrics, so starting off with their growth metrics, we can see they did get a grade B. Now, when we take a deeper dive, we can see year-on-year increase to their top line, 5.74%. Now, the sector median did come in at higher, hence why they got that rating. Forward-looking growth around 7%, again lower than the median in the industry. So we can see for the majority of these metrics, forward-looking as well, they are slightly lagging what is expected from this industry. However, a much better look when we are talking about their earnings per share, significantly higher than the sector median. So there are some areas that they could grow, and we will touch upon this when we do talk about their forward guidance in 2024 and beyond. Much better, however, on the profitability metrics. They do get an A+. We can see very, very strong. Profit margin itself, 70% above sector median. EBIT margin, 36%, significantly above the sector median. And when we look at their bottom line, up 27%, we can in fact note the majority in this sector do have a negative bottom line. So lots to like here, as we can clearly see. And if you do want to take a look, you can pause the screen and look at other of these metrics in detail. But let's move on. Now, before we will touch upon their dividend safety, insider ownership does sit at 0.15%. Now, what we note here is 9 million worth of sales over the last 12 months by 4 different insiders, and we can take a quick look just to point some of these out. Now, in fact, over the last few months, it comes the same insider, Roxanne L, the EVP, has sold a fair number of shares just in 2024 alone, as we can see here, totaling just under $400,000. Now, insiders will sell, and there will be many reasons why they will sell: personal, financial. We can't really pinpoint it. We never really say that is a bearish signal, but the information is there when you do your own due diligence, so you can then make a conclusion based on this information. But as always, insider buying is what we consider to be a bullish signal. Now, institutional ownership, 93%. We see a fair amount of sales by the institutions over the last 12 months, but a lot more buying over the same period. In fact, 91.12 billion. The largest buy being in Q2 of 85 billion. When we look at Q4 of last year, a lot more buying than selling. In Q1, we don't have the full data set just yet, but what the information we do have, we do see more selling than buying. So always do your own due diligence, never copy what the institutions do, but always interesting to see their moves. And the majority, as we can see, of these institutions have been buying shares of Zoetis. Now, a few things to pull out from their latest investor presentation, which did run through their Q4 as well as their full year 2023 financial results. What we want to bring to your attention on a Q4 basis, so this is their latest quarter, Q4 23 versus Q4 22. They increased their top line by 8%, their bottom line by 14%, and we can see here that their adjusted earnings per share coming in at 8%, and their adjusted net income again 6%. So this is a company that is increasing their top line as well as their bottom line and their earnings per share quarter on quarter, which is always a positive sign. And what we want to point out in the full year report is that their reported earnings per share 507, higher than the full year of 449, up by 13%. And this is important because for their forward guidance, they are estimating it to be higher than their current 23 report. Now, as we're going to have a quick look at their forward guidance, full year FY24, they are expecting revenue increase to around 7 to 9%, which is very healthy, as well as that reported earnings per share 534 to 544, again an increase to the previous year. So lots of growth still expected for this company, high single digits, so something to factor in when we do move on to the valuation. And just to let you know, we have released our latest free weekly article. We run through 10 stocks with a lot of upside. In fact, the previous article also talked about some undervalued dividend stocks. If you want to gain access to all of these articles, all completely free, click on that pinned comment below and you can start reading, instant access straight away. Dividend safety, straight away the score 74, it is safe. Market cap 75 billion, it is a large cap company. Now, last recession, well, they didn't pay a dividend, so we don't have those data available, but they did have plus 30% recession sales, which was significantly above the average growth that sat at negative 12%. So that is a positive sign if you are a believer of an inbound recession. Last increase to their dividend, well, in December, 15%, very positive over the last 5 years, double digits. Over the last 10 years, 23%, very, very strong. This is something you really like to see as a dividend growth investor. And they have been increasing those dividends for the last 10 years, at what point they did initiate the dividend. In terms of dividend yield theory, now, as always, it states a company is undervalued when the current yield sits above the 5-year average. We see signal 1 here for undervaluation. Our second undervaluation signal with the forward P 28 below the rolling 5-year average of 33.9. But again, bear in mind, we don't look at any of these models in isolation and will conclude towards the end. We also point out that the healthcare sector P does sit significantly lower at 16.2. Now, what we want to focus on is the free cash flow payout to understand that they can cover that dividend. Data available if you want to see the earnings. It is susceptible to manipulation by management through accounting. My blanket rule, 60% or lower, gives me faith that management can offer those double-digit dividend increases. Significantly lower than that year on year. In fact, 2024 at 36%. I would be shocked if this December we do not see another strong double-digit dividend increase for Zoetis. Free cash flow also increasing over the longer term. Granted, it isn't consistent, but when you are a long-term investor, this still is very positive. 2024, again, we can see they are increasing it to around 477 expected. Now, in terms of sales growth, for those who want to see the percentage, 3 to 7% seems to be pretty much beaten nearly every single year or thereabouts. 2021, a very strong year, and for those that do want to see that numbers again in a different format, we can see they have nearly doubled their top line over the longer term. One thing they do, although very, very small in terms of their shares outstanding, is those share buybacks. 502 million brought down to 462 in the latest quarter. It does return excess cash, essentially giving you more portion of the company, but it isn't at a very rapid rate, so it is fairly trivial, but we do still want to highlight that. Return on invested capital above 10% is what I like to see. It is pretty consistently very strong around the low 20s. In fact, 2023 at 26% is very strong, attractive to those potential investors. Does give you faith when you are analyzing internal management as part of your investment thesis that they are able to efficiently allocate that capital. Now, operating margin, very strong sign of operational efficiency, increasing the margin while also increasing the top line. That does wonders for a company's income statement. And we can see free cash flow margin as well, very, very strong. In fact, the last year at 19%, very healthy. So no worries with their free cash flow and no worries with their margins as a whole. In terms of the net debt to EBITDA, the earnings before interest, tax, depreciation, amortization, this does affect the dividend safety, it does affect the balance sheet strength, and these are essentially the number of years it would take the company to pay off all of their debt net of cash on hand. We want to see below 3. What's nice to note, it has been decreasing over the longer term. 1.2 expected in 2024. No worries with their balance sheet, no worries with their dividend safety. It does look like a very strong contender to be added to your watch list at a minimum. Now let's jump into the valuation model, and as always, if you do enjoy the content, value is being provided. Smash that like button, hit that subscribe and bell button so you are continually notified of these videos as they drop. So let's jump into the first model. We have the multiples valuation model, companies in a similar sector and size. Average P multiplied by that of Zoetis to get our intrinsic value, showing our first sign of undervaluation, although we do note it isn't too far off, around 5% from that market value. And again, even with these models, we don't look at any one in individuality. Dividend discount model, we have the yearly dividends year on year, average growth rate very, very strong at 22%. We do see the forward-looking growth rate at 7.25 being a lot more conservative. This gives an intrinsic value showing some significant undervaluation signals, and this is one of my favorite dividend growth companies when you do look at it purely at the aspect of how quickly they are increasing those dividends. Now, DCF model, as always, we put the free cash flow year on year. We have the growth rate of 19.3%. We've gone for around 20%, again, pretty much in line with the average growth rate. With the discount rate, we get the present value of future free cash flows and terminal value. Add together with the cash, subtract total debt, get to the equity value, divide by the shares outstanding, and we get another undervaluation signal, as we can see here. So in today's episode for Zoetis, we do have a triple undervaluation signal, and the intrinsic value is purely the average of these three models. Bear in mind as well, you can grab a copy of the valuation model to get to the intrinsic value of companies in your own portfolio, as well as the acceptable buy price, and you can also look at other companies like those on your watch list. As always then, to execute, we do start off with a minimum 10% margin of safety, and we do use that if it meets the three criteria. As always, the same three criteria: a wide moat, strong financial metrics, good forward-looking data. If you believe that, well, it's a buy up to $191. At 15%, a buy up to $180. At 20%, $167 or $169 in fact. At 25%, pretty much nearly at a 25% MOS level. So we say between 20 to 25, more steering towards the 25%. So that does indicate a very strong buy if you do believe this is a very high quality company that you do want to consider for the portfolio. Wall Street, on the other hand, they have a price target much higher than our intrinsic value. They see upside of 40%. They believe this is an incredibly strong buy, one that you must have in the portfolio at a minimum for consideration. But as always, let us know your thoughts in the comments below. There is a lot to love with this company. It does really depend if you want a company in this industry within your portfolio, or maybe if you do like this company in terms of the upside and margin of safety that it has. As always, let us know your thoughts in the comments below. Is this one you are looking to add? Maybe this is one now for your watch list for you to go and look at your own investment thesis and apply it to this company. Or let us also know if there is a reason why this isn't one you are particularly keen on adding. As always, if you enjoyed the episode, smash the like button, hit that subscribe and bell button, and as always, we'll see you all on the next one.